Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 2. This is section H. This is a remembering and understanding topic. Recall the appropriate presentation of gains and losses on derivative financial instruments such as swaps, options, and forwards in the financial statements. And to be totally honest, we are mainly going to focus on options. In fact, we're only focusing on options in this video because that is mainly what I've seen in the AICPA type questions. So that's what we're going to mainly be focusing on today. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after that, you're going to want to learn more. So make sure you also check out becoming a SuperfastCPA Pro member to get access to the full versions of these videos. In today's video, we are only doing 5 questions for the YouTube version, but SuperfastCPA Pro members will get access to the full 10-question version of the video. So make sure you check out becoming a SuperfastCPA Pro member after you check out the webinar. Now let's dive into the questions for this video. All right, here we are at question 1. Now, as I said, for this video, even though the blueprint topic is talking about some other things, this is kind of underneath that blueprint topic, like it's a piece of the blueprint topic. We're mainly talking about options and their gains and losses and how you calculate that in this video. Because again, that's mainly what I've seen in the AICPA questions. You know, there might be some other ways to cover this, but this is what I wanted to focus on today. And one last thing that I will say about all of these questions that we're about to be going through, none of them are hedges, and all of them would show up on the P&L, on the income statement, all of these gains and these losses. So I just want to make sure that that's clear right at the start, because I'm not going to say that for every single question. Now let's dive into question 1. Now, as we dive into question 1, I always like to give this tip if it's an option. You want to read the last sentence of a question first. Frequently, this will give you context for what the question is about so that you know what you're looking for throughout the rest of the question. So read the last sentence first and then go to the top and start from there. So let's do that here. Based on this information, will PineCo benefit from the stock price increasing or decreasing? And what is the gain or loss on the option at expiration? Let's go up to the top. PineCo purchases a call option, giving it the right to buy 1,000 shares of Oak Corp stock at a strike price of $50 per share. The option expires in 3 months, and PineCo pays a $2 per share premium. At the option's expiration date, Oak Corp's stock price is $56 per share. So again, based on this information, will PineCo benefit from the stock price increasing or decreasing, and what is the gain or loss from the option at expiration? Now, if you have any idea how this works, that's great. If you know what a call option is and if you know how you would calculate this, again, that's great. But if you don't know, that is fine. We are going to use these questions to learn this specific topic. So let's go ahead and dive into the explanation here in just a second after we look at the options. So is it either going to benefit from a price increase and have a gain of 6,000, or still benefit from a price increase but only have a gain of 4,000? And then the opposites, will it benefit from a price decrease and have a gain of 4,000 or 6,000? So let's go ahead and take a look at the explanation now that we know the options. All right, here we are at the answer. B, PineCo benefits from a price increase and they have a gain of $4,000. So let's walk through this. We're going to talk about call options and hopefully you'll understand how they work right after this. A call option gives the holder the right, but not the obligation, to purchase the underlying asset at the strike price. So basically they're saying, hey, we'll pay you this premium to be able to buy the stock at a very specific price. And the reason they would do this is because they want to buy it just in case the stock price goes up. The buyer of a call option benefits when the market price increases above the strike price. And let's go through this and you'll understand that. So the strike price that they paid for was $50 per share. The market price at expiration was $56 per share, so it had gone up. The intrinsic value per share is $6. So each share is actually worth $6 more to them because they're only paying $50 for $56 stock. So the total intrinsic value is $6 times 1,000 shares, that's $6,000. But they did have to pay a premium on each of those shares to be able to have the call option. So subtract $2,000 and that gives you a net gain of $4,000. So again, they had that call option, they paid $2 premium per share, the $2,000, to be able to buy the stock at $50 per share instead of, whatever the price was if they used the option, which was $56 in this question. So again, they got $56 stock for $50 per share. They had to pay $2, so really it was $52 per share to get $56 stock. So that's a net gain of $4,000. Again, that is going to show up on the P&L. And as you can see in this question, if somebody buys a call option and the market price goes above the strike price, then that is a benefit to the person who got the call option because they are going to get stock or shares cheaper than what the market has currently because they have that call option that they're able to use. Now, if you think about this, this could also go somewhat poorly because if they pay the premium, because they do have to pay the premium, if they pay the premium, but then the stock actually goes below the strike price, they're not going to use the option, but they did already pay the $2,000 premium, so that would be a $2,000 loss for them. Just kind of thinking about it the other way. Now let's go to the next question. All right, here we are at question 2. Will Elm Co. benefit from the stock price increasing or decreasing, and what is Elm's total gain at expiration? And by the way, most of the questions in this video are going to be similar, just about maybe different types of options or from a different perspective. Elm Co. sells a call option giving the buyer the right to purchase 600 shares of Pine Corp stock at a strike price of $70 per share. Elm receives a premium of $5 per share. At expiration, Pine Corp's stock price is $66 per share. So again, will they benefit if it increases or decreases, and what will be the total gain at expiration? So again, are they going to benefit if it decreases and have either a gain of $3,000 or $2,400? Or will they benefit if the price increases, and will they have a gain of $3,000 or $2,400? So this is kind of the opposite side of things. This is where somebody sold a call option. So how will they benefit from this? Think about this, pause the video if you need to, and come back when you're ready. All right, here we are. The answer is A. Elm benefits from a price decrease and they get a gain of $3,000. Let's walk through this and you'll see it's a little bit different when it's from the seller's perspective. A call option seller, who is the writer, benefits when the market price stays below the strike price because the buyer will not exercise the option, allowing the seller to keep the premium. So the strike price is $70. The market price expiration was $66, so that's below the strike price, so the option expires worthless. They're not going to use a call option if they could just buy the stock for cheaper anyway. They want to use a call option when the stock is more expensive so that they are saving money by buying that same stock for less cash. And the premium received here is $5 times 600 shares, that's $3,000. So Elm gets the $3,000 of premium, and since the option wasn't exercised, because why would they exercise a call option on something that had a market price below the strike price? The entire gain is the premium that Elm received. So the seller benefits from a price decrease because it makes it less likely the buyer will exercise the call option. So again, Elm does have a gain on their books of $3,000 because the premium that was paid to them, $5 multiplied by 600 shares, they get to keep that, and the call option is not used because the market price was below the strike price. So from the seller's perspective, that's when it benefits. Now, from the other way, from the seller's perspective, if the market price went above the strike price, then they don't like that as much because then they're having somebody buy their stock for less than it's worth on the market, but the other person had a call option, so they are allowed to do that. So again, you're kind of seeing the difference here, seeing both sides here. Now let's go to the next question. All right, here we are at question 3. Will Summit Co. benefit from the stock price increasing or decreasing, and what is Summit's total gain or loss at expiration? So again, similar question throughout most of this video, but different situations. Summit Co. sells a put option, giving the buyer the right to sell 900 shares of Valley Corp stock to Summit at a strike price of $30 per share. Summit receives a premium of $1.50 per share. At expiration, Valley Corp's stock price is $33 per share. So again, this is a little bit different. This is an option, but it's a put option instead of a call option. Now, if you don't know what a put option is compared to a call option, it kind of says it right there. A call option is having the right to buy stock at a certain price. Put option is having the right to sell stock at a certain price. So based on what we see here, again, are they going to benefit from an increase or a decrease? And will they have a gain? Or, well, it looks like they're just going to have a gain in this situation based on the answers. Think about this. Pause the video if you need to. It's a little bit different than what we've seen before, but again, based on what you saw in question 1 and 2, you might be able to think your way through this. So give it a shot, and when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is C. Summit benefits from a price increase, and the gain is $1,350. So let's go through this. Again, this is for a put option instead of a call option. A put option seller, which again is the writer, benefits when the market price stays above the strike price because the buyer will not exercise the option. They could sell the shares in the open market for more money. In that case, the seller keeps the premium as profit. So let's think through this. The strike price was $30 for the put option. The market price is $33, which is above strike. So the option expires because they don't want to use the put option to sell stock at $30 when they could be selling it for $33 on the open market. Now, the premium that was received to do all this is $1.50 times 900 shares equaling $1,350. Since no shares were purchased by the seller, because, again, the put option was not used because the put option wasn't as useful as just selling on the open market for $3 more. So the full premium is profit for Summit because they are the one who sold the put option. They're the one who said, we will buy your shares if the strike price goes below the $30 or whatever the case is. The seller benefits from a price increase because it makes it unlikely the buyer will exercise the put option. So as you can see in this question, this is kind of the opposite of a call option. The put option is having the right to sell it, and we saw how to calculate it there. Now let's go to the next question. All right, here we are at question 4. What is Canyon Co.'s net gain or loss on the option at expiration? Let's go up to the top. Canyon Co. purchases a put option giving it the right to sell 700 shares of Mesa Corp stock at a strike price of $42 per share. Canyon pays a premium of $2 per share. At expiration, Mesa Corp stock price is $37 per share. So again, will Canyon Co. have a net gain or loss on the option? Now this is a put option. This is something we've seen in question 3. Think through what we just learned, think through this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is D, $2,100 gain. So let's go through this again. This is for a put option. A put option buyer profits when the market price is below the strike price because they can sell shares at the higher strike price. So the strike price was $42. The market price at the end was $37. So the intrinsic value per share is $5. So the total intrinsic value is $5 multiplied by 700 shares. That's $3,500. They did have to pay a premium of $2 per share. So they actually get $1,400 of that taken out. So the net gain is actually $2,100. But again, they are benefiting here because they have an option to be able to sell at the higher price than the lower market price because that's what a put option does. But they did pay a $2 premium to be able to do that. So they pay that $2 premium, but now that the market price is $37 instead of $42, they are able to sell shares for $42 instead of $37, and so that gives them a big benefit. Since the market price fell below the strike price, they exercise the option and they again get a gain of $2,100. So again, I hope you're seeing the difference between call options and put options and buyer seller in those situations. Now let's go to the next question. Okay, here we are at question 5. Which of the following best explains why a buyer of a call option and a seller of a put option both benefit when the price of the underlying stock increases? Let's go through this. We've been kind of learning this throughout the video. Option A, a higher stock price allows the call buyer to purchase shares below market value, while the put seller avoids having to buy shares at above market price. Option B, a higher stock price increases the premium owed to the call buyer and reduces the premium kept by the put seller. Option C, a higher stock price guarantees both the call buyer and the put seller can resell the option for more than they paid or received. Or option D, a higher stock price forces the call buyer to sell shares to the put seller at a favorable price. So again, based on everything we've learned in the previous 4 questions, you might be able to figure this out and think through this. Why would they have the same benefit, a buyer of a call option and a seller of a put option, if the stock increases? So think about this. Come back when you're ready. All right, here we are at the answer. A higher stock price allows the call buyer to purchase shares below market value, while the put seller avoids having to buy shares at an above market price. A call option buyer benefits when the market price rises above the strike price because they can purchase the underlying stock at the lower strike price and either keep it or sell it at the higher market price. A put option seller benefits when the market price rises because the buyer of the put option will not exercise it. They can sell shares in the open market for more than the strike price. This allows the seller to keep the premium as profit without having to buy the stock at an above market price. So again, you can kind of see how they're similar, but on different sides of, the spectrum. A buyer of a call option benefits from stock increasing, and a seller of a put option also benefits, but for different reasons. So with that, we've gone over a lot in these 5 questions. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 multiple choice questions or even a whole sim talking about a specific subject, such as, again, how to know when a buyer of a call option will benefit or how a seller of a put option will benefit and how to calculate their gains or losses. These are the kind of things that you're noticing throughout the questions, and you take a moment and write out the things that you learned as the pillar topics, as the most important things that you learned from the questions. And as you're doing this each day, you are going to be building your own personal repository of the most important things you learned from the questions so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Call option buyers gain when prices rise. They profit when the market price exceeds the strike price because they can buy shares below market value. Their net gain equals the intrinsic value minus the premium paid. Call option sellers gain when prices fall or stay the same. They keep the premium if the market price is at or below the strike price because the buyer will not exercise the option. Now let's talk about put option. Put option buyers gain when prices fall. They profit when the market price is below the strike price because they can sell shares above market value. Their net gain equals the intrinsic value minus the premium paid. And then now the put option sellers gain when prices rise or stay the same. They keep the premium if the market price is at or above the strike price because the buyer will not exercise the option. And then finally, option position benefits depend on price direction. Buyers benefit when price moves in their favor relative to the strike, while sellers benefit when price movement makes exercising unprofitable for the buyer. So those are the kinds of concepts that you kind of need to be thinking about as you leave this video. Now, again, that is the end of the YouTube version of this video. We only went over 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. I'm about to finish that video after I do this one. So again, if you like this and you like our other videos, make sure you check out becoming a Superfast CPA Pro member to get access to the full versions. And the easiest way to learn about and become a Superfast CPA Pro member is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So check out the webinar, check out becoming a pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.